Hi guys, welcome to Bankers Cafe. Today's topic for discussion is merchanting trade. We will cover following topics. These are: what is merchanting trade, what are the features of merchanting trade are, what is the time frame required for completion of merchanting trade cycle, categorization of goods under FTP. Here FTP stands for foreign trade policy. What are the type of payments under MTT? We will discuss these in details. Write-off of unrealized amount of export lag. What are the guidelines for banks under write-off process? After that, we will discuss the comparison of previous MTT guideline with the latest MTT guideline. And in the end, we will talk about the type of products which are not allowed under MTT transaction. Let's begin. Merchanting trade. It can also be called as intermediary trade. Why it is being called as intermediary trade? Because it is that type of trade transaction which is facilitated by an intermediary. So whenever an intermediary is facilitating a trade transaction between the two foreign entity, means the buyer and the overseas supplier, so that trade transaction would be called as merchanting trade transaction in Indian context. Means whenever the trade between two foreign entity is facilitated by a Indian trader or a Indian merchanter or a Indian intermediary, then it will be called as merchanting trade. Or in simple word, we can say that it is that intermediary trade transaction between overseas buyer and overseas supplier takes place through a merchant trader. That is called merchanting trade, right? Under merchanting trade, the Indian merchanter or the Indian intermediary will play the role of both the exporter as well as, and it also plays the role of importer as well as. And the one key point which we need to remember under merchanting trade, that the goods will not enter the territory of a intermediary. If the goods enter the domestic territory of a intermediary, then that transaction cannot be classified as merchanting trade transaction. So if a transaction is need to be classified as merchanting trade, then the goods shall not enter the domestic tariff area of a merchanter. Now we will discuss about the feature of merchanting trade. The intermediary trade and the goods does not enter merchanter country. We have already discussed these two features in merchanting trade, right? Let's move on the third feature, that is the all entity are non-resident for each other. As we know that under merchanting trade transaction, basically there are three parties are involved. One is the overseas buyer, overseas supplier, and the Indian entity, right? So under this merchanting trade, all the three entities are residing in different countries. So these three entities are non-resident for each other because they are residing in different country, right? And the last feature is multiple transaction. Under merchant trade, there are multiple transactions which is need to be executed. That is, the import leg is also need to be made, export leg receipt is also need to be processed. So merchanting trade transaction basically is a combination of import transaction as well as export transaction, right? Now we will discuss the time frame which is required for completion of a merchanting trade cycle. As per the Reserve Bank of India guideline, the entire merchant trade transaction should be completed within 9 months. Means the whole MTT transaction, means the both leg should be completed within 9 months. After that, the outlay of foreign exchange. Outlay of foreign exchange should not go beyond 4-month deadline. What is this outlay of foreign exchange means? Basically, in order to understand this outlay of foreign exchange, let's assume a situation that the Indian intermediary, means the merchanter, has received the export leg in advance with today's value date, then the import lag payment should be made within 4 months from the date of today's value date. Then it will be called as outlay of foreign exchange is within 4 months. Or in let's understand the same with different aspect. Uh, Here the Indian trader has made the import lag payment in advance, right? With today's value date. So the export lag should receive within 4 months from today's value date. That is called outlay of foreign exchange should be within 4 months. Means if one of the leg of merchanting trade transaction is completed, then the another leg should be completed within 4 months from that completion date of that first leg. That is called outlay of foreign exchange, right? If one leg is completed, then another leg should be completed within 4 months. It should not completed beyond that 4-month timeline, right? Else it would breach the MTT guideline. Now we will talk about the start date of merchanting trade transaction and the closure date of merchanting trade transaction. Which date would be considered as a start date of merchanting trade transaction? It can be a shipment date, it can be a export leg receipt date, or it can be a import leg payment date. Whichever the date is first, that date would be considered as a starting date of merchanting trade transaction. Means if the shipment happens before receiving export leg and before making import leg payment, then the shipment date would be considered as a starting date of merchanting trade transaction. If export leg is received in advance before the shipment happens or before making import leg payment, then the export leg receipt date would be the starting date of merchanting trade transaction. Or if the import leg payment is made in advance before the shipment happens or before receiving the export leg receipt, then the import leg payment date would be the starting date of that merchanting trade transaction. Means out of these three dates, whichever the date is first, that would be the starting date of merchanting trade transaction. In the same scenario, whichever the date is the last, then the date would be considered as closure date of merchanting trade transaction. Means out of these three dates, whichever the date is last, whichever the date is having the last date would be considered as a completion date of merchanting trade transaction. So the whole transaction, the starting date and the closing date of merchanting trade transaction should be completed within 9 months. Let's move forward. Now here we will discuss the details about merchanting trade transaction. More details about merchanting trade transaction, right? As per the RBI guideline, the entire merchant trade is to be routed from same bank only. Means if the merchant trader has received the export leg in advance with one bank, then the import leg payment should be made from that bank only. Or if the import leg is made from one bank, then the export leg should be received in that same bank only. Means both the legs should be routed from a same bank only. After that, the goods acquired shall not enter the domestic tariff area of an intermediary. As it is the basic principle of a merchanting trade transaction that the goods which are acquired under merchanting trade transaction should not enter the domestic territory of a merchanter. If it is entered the domestic territory of an intermediary, then it can't be classified as a merchanting trade transaction. So the goods does not enter the territory of a, or should not enter the territory of a merchanter or an intermediary, right? The acquired goods can undergo transformation. Now this point is need to be remembered or need to be noted that in previous guideline of merchanting trade transaction which is issued by Reserve Bank of India, there it is mentioned that the goods can't undergo transformation. But in revised guideline, RBI has allowed undergo transformation of goods in some cases. Means in some cases the goods can undergo transformation. That is depend on the satisfaction of a bank, how that bank is satisfied with that transaction, what is the bona fide, if the bank is satisfied with the bona fide transaction of that intermediary. If the bank is satisfied, the bank can allow to undergo its goods transformation. The transformation can be in the any form. It can be in a value addition form. It can be any form. So it solely depend on the bank. If bank is satisfied with the documentary evidence, the bank can allow a goods can undergo transformation. Earlier, which is prohibited, right? After that, the merchant and the bank must be ensured that the goods which are acquired under merchanting trade should be the one which is permitted as per the import and export policy or under the FTP policy. Means under merchanting trade, the merchant can only deal with the goods which are permitted under the foreign trade policy of India, right? Under import and export leg under the merchanting trade, in import leg, the merchantator is not required to submit the bill of entry under merchant trade transaction. Means under merchant trade transaction and under that import leg payment or under that import leg settlement, the importer or that merchantator is not required to submit the bill of entry. In the same scenario, the merchantator is not required to submit the EDF or the shipping bill in export case. Means the merchantator is exempted to submit the bill of entry in case of import, and it is exempted to submit the EDF or the shipping bill in case of export. Rest other document is need to be submitted as per the FTP, right? Now we will talk about the categorization of goods. These goods are categorized according to the FTP. According to FTP, the goods is categorized into three parts. First is the restricted good, second one is the prohibited good, and the third one is the permissible goods. Restricted goods basically are those goods on which there is a restriction is imposed. Means if restricted good is need to be imported or if it is need to be exported, then a prior permission is required from a specific department or from the Reserve Bank of India as the condition apply. As may the condition apply, right? What is the prohibited good? The goods which is banned for importing and the goods which are banned from exporting, that are called prohibited. Means which goods which can't be imported and can't be exported. Permissible goods, goods which are permitted for import and export without any approval from any authority. Means these goods are freely to import and freely to export. Now we will talk about the type of payments under merchanting trade. Basically there are two type of payments under merchanting trade transaction. These are import leg payment and the export leg receipt. We will discuss these two payments in detail later in this video only. This is a diagram where there are three entities are there, A, B and C. A denotes the overseas supplier, B depicts the Indian customer, means the merchantator or intermediary, we can say that. C is the overseas buyer. So under this, if a transaction happen between A and B and A might having the fear of risk failure, then the A would require an LC. A would instruct the B to provide an LC from his bank. So whenever the B means the Indian entity as I mentioned here. So whenever the B is providing a LC from his bank in favor of supplier, then that LC would be import LC. For whom? For the merchantator. In the same scenario, whenever the B is receiving LC in his own favor from entity C, that is the overseas buyer, then for entity B it will be called as export LC because it is receiving LC from overseas buyer. Whereas in entity A and B it is providing LC in favor of overseas supplier. That would be import LC for the Indian merchant, right? So I've mentioned both the aspect where it would be import LC for Indian merchant and when it would be export LC for Indian merchant, right? Now we will move on to this diagram, which is depicting what is the import leg and what is the export leg. Here three parties are there: buyer, intermediary and the supplier. If the intermediary need to export the good to the buyer, before exporting that goods to the buyer, it must need to import those goods from the supplier. Then only it can ship the goods to the buyer, right? So whenever the intermediary is importing the goods from the supplier, then for the intermediary it will be called as import lag because here it is importing the goods from the overseas supplier. So it will be called as import lag for intermediary. Then what is called export lag? After importing the goods from the overseas supplier, now that intermediary will export these goods to the overseas buyer. So then it will be called as export lag for intermediary because it is exporting now goods to the overseas buyer. So in simple scenario, when intermediary is importing goods, then it will be called as import lag for intermediary. When it is exporting goods, then it will be called as export lag for intermediary, right? This diagram is from intermediary's point of view, means both leg is defined from intermediary's point of view, right? In case of shipment, what actually happens, which will be the stage 1 and which will be the stage 2, means what will be happen first and what will be happen later. In case of shipment, as who is the owner of goods, actually the overseas supplier is having the possession of those goods, means that it is the seller of those goods. So when it ship the goods to the intermediary, then only intermediary can ship those goods to the buyer. If the supplier is not shipping the goods to the intermediary, then can it be possible that intermediary can ship the goods to the buyer? No. So in case of shipment, we are talking about in case of shipment, the supplier will ship the goods first and these goods will be imported by the intermediary. After that intermediary will resell those goods which is imported from the supplier to the buyer. So the stage between the supplier and the intermediary would be the stage 1 because here the goods is being exported from the actual supplier, means it is the stage 1. After that the stage 2 will be that stage where after receiving the goods from the supplier, it is being resold by the Indian trader to the buyer. So it would be the stage 2. After importing from the supplier, then only it can ship the goods to the buyer, then it means it is the second stage. So import lag in case of shipment would be the first stage, export lag in case of shipment would be the second stage. Let's move forward. Now we will talk about in case of payment. Means in case of payment, it depends on the agreement, means the agreement which a Indian intermediary or a Indian merchant is having with the buyer and having with the supplier. Means if the let us take an example. Suppose Indian intermediary is having a agreement with the buyer that the buyer has to make the payment to the intermediary in advance. Means here intermediary is receiving an export lag in advance, means whichever payment is first, either we are receiving the payment or we are making the payment. So whichever the payment is first, that will be called as stage 1. So here the export leg is receiving first, that means the stage 1 in case of payment would be the export leg. Thus in the same scenario, it would be called as the import leg for stage 2. Stage 2 will be called as import leg, right? If it is a situation that intermediary has to make the import leg payment first before receiving that export leg, then import leg would be the first stage and the export leg would be the second stage automatically, right? So whichever the payment is being made or received first, then it will be called as a stage 1 and the second will be automatically called as stage 2. Now we will talk about the export leg. What is export leg? In export leg, the intermediary or the merchanttor, or means we can say that the Indian entity is acting as an exporter, because here it is exporting the goods. So whenever it is exporting the goods, means that someone is buying the goods. So the overseas buyer is the importer of that goods. So after that, whenever the overseas buyer has imported the goods, then it will make the payment against that imported goods to the intermediary. So whenever the buyer makes the payment to the intermediary against that the imported goods, so the buyer has imported the goods and the intermediary has exported the goods. So for the intermediary it will be export and for the buyer it will be import. So the buyer when make the payment to the intermediary, then for intermediary it is export payment because it has received the payment against the export, then it will be called as export leg receipt. Then it will be export leg receipt for the merchanttor, right? Now also one point is need to be noted that as per the Reserve Bank of India guideline, if the export leg receipt is received in advance before making the import leg payment, then the whole amount of export leg should be lien marked or earmarked for the full amount, because that amount is need to be utilized or that need to be unlien at the time of import leg payment. Means if the export leg receipt is in advance, then at the time of import leg payment that amount will be unlien and import leg payment is being made and the balance is being transferred to the intermediary account. The export leg can be credited in EFC account or it can be credited in INR account. It is depend on the intermediary request where it needs the credit. EFC stands for the exchange under foreign currency account. It is basically an account which is maintained in foreign currency. It can be USD dollar, it can be GBP, it can be euro, it can be any currency which is permitted, right? Now we will talk about the import leg. Under import leg, intermediary is the importer, means Indian entity is acting as an importer, whereas the overseas supplier is the exporter. So whenever the Indian intermediary is importing the goods, then after that it need to make the payment against the imported goods. So whenever the Indian party or Indian entity is making the payment against the imported good, then for the Indian entity it will be called as import leg because it has to make the payment against that imported goods to the overseas supplier. So for Indian trader it will be called as import leg, right? Import leg payment, if the import leg payment is being made in advance, then it can be made out of the EFC account also. If import leg payment is being made after receiving the export leg, then it should be made out of the amount which is lien marked, right? Import leg payment can be made prior to the receiving of the export leg receipt. Means import leg payment can be made in advance before receiving the export leg receipt. Now question arises that for how much amount it can make an advance payment against import leg. As per previous guideline, it can make the advance payment of up to USD 2 lakh. but in revised guideline it can make advance payment up to USD 5 lakh without any guarantee. Beyond that amount, beyond that USD 5 lakh, it requires a bank guarantee or a unconditional SBLC from correspondent bank, right? So import payment can be made in advance before receiving the export leg. Also, it can be made in advance up to the amount of USD 5 lakh without any guarantee or LC. But beyond that amount, beyond that limit, a bank guarantee or an SBLC is required. Buyer's credit and supplier's credit can be issued under merchanting trade transaction. It is need to be noted, right? Now, if that overseas supplier might having a fear of risk of payment failure from intermediary side, then it would ask an intermediary to provide an LC in his own favor. So whenever the Indian intermediary is providing an LC in favor of overseas supplier, then that LC would be called as import LC for the intermediary, as we have learned in the past in this video only, right? Let's move forward. Now we will talk about the write-off of unrealized amount of export leg. In what cases the export leg amount which is being kept outstanding that can be write-off? There are three scenarios where it can be write-off. If the buyer is declared as insolvent, means wherever the buyer is insolvent, or means we can say that wherever the buyer is declared insolvent, then it should be documented along with the proof from the liquidator who certified that amount cannot be recovered from the buyer. Means if the buyer is insolvent, then a documented proof is required which should be stated that an amount cannot be recovered from that buyer. These wording should be there in that amount cannot be recovered from that buyer. The another one is that auction of that exported goods, means whenever the goods has been exported on auction, then where actually an auction is what? Auction basically is a process of of buying and selling of goods in public place. By taking a part in the bid. So whenever the goods has been exported in the auction, then a certificate is required that goods has been exported for an auction. The certificate is required. Then the unrealized amount of export leg can be write off. If the goods has been destroyed by the importing country's port or custom or any other authority, then also a certificate is required that the goods has been destroyed, which is stating that the goods has been destroyed. So a certificate is also required. So whenever that certificate is provided, then the unrealized amount of export leg can also be write off by the bank. And in the last situation, whenever there is a settlement by an intervention of an Indian embassy or a foreign chamber of commerce, then the amount will reflect in the unrealized amount of export leg. Means the amount will reflect in the outstanding list of export leg where it is unrealized. So that amount can be write off by the bank automatically. If it is not write off by the bank, then the merchant trader can put a notice in front of the bank stating that this is already settled by through an Indian embassy or by a foreign chamber of commerce. Then the bank can write off. If the bank that missed that, but it can't be possible. But if a situation arises, if the bank forget to settle that or forget to write off that, then the merchant trader can draw attention on that. So wherever the amount is reflecting outstanding in an export leg where the settlement is already happened through a Indian embassy, foreign chamber of commerce or any other authorities, then the bank can write off this. This type of merchanting trade transaction can be in the form of these type of 8 products. It can be in the form of import LC issuance, it can be in open account payments, it can be in import collection transaction, it can be export collection transaction, it can be advance against export, it can be advance against import, it can be in the form of buyer's credit, and in the end it can also be in the form of export LC discounting. Means merchanting trade can be in the form of all these 8 type of transaction. Means merchanting trade can be happen in all 8 transaction. And what are the products or transaction where merchanting trade is prohibited? Wherever the advance against export is received, then bank guarantee can't be issued against that. Wherever we have received the advance against export, means the export leg is received, then the bank guarantee can't be issued. A third party payments as well as the agency commission payment are also not allowed. Third party payment and agency commission payment are also not allowed under merchanting trade transaction. So these are the type of payments or products which are not allowed under merchanting trade transaction. This is a situation where the value of import leg is higher than the value of export leg. Means here the merchanter has imported the goods of higher value, but it has exported the good of lower value. Means it has incurred a loss here. In another situation, here the value of export leg is higher than the value of import leg. Means here the goods which are exported is of higher value than the goods imported. Means here the merchantator has imported goods of less value and sells the goods of higher value. Means here it earns a profit or it earns a commission here. How can we derive the commission or the profit of a merchantator or intermediary? Basically, it can be derived by taking the difference between of a export leg receipt and the import leg payment. That will be the merchantator profit. What bank need to ensure while right of request has receipt for the unrealized export leg? Whenever a merchantator has requested for write-off of his unrealized export leg amount, then bank need to ensure that the KYC is in place of that merchantator and there is no AML concern has been raised in the past against that merchantator. What is that AML? That stands for anti-money laundering. There is no anti-money laundering case has been raised or issued against that, or any memo has been issued against that intermediary in the past. That bank has need to be ensure that while processing any write-off process of unrealized export leg amount. So if the bank has received such request, the bank also need to be ascertained that transaction is not being investigated by any agency operated under the FEMA. If if a bank has received any right of request of unrealized export leg, then bank also need to ascertain that this transaction is being not investigated by any agencies under Foreign Exchange Management Act. If that transaction is being investigated, then bank can't write off that unrealized export leg value. After that, in the last point, the merchantator counterparties mean the overseas buyer and the overseas supplier, neither their country nor their jurisdiction should reflect in the FATF list. What is this FATF list? Yes, FATF list is that list which is known as Financial Action Task Force, means the blacklisted. So nor their country nor their jurisdiction should reflect in FATF list. So bank need to ensure while writing of any unrealized export leg value. Now we will talk about the comparison of previous guideline of MTT with the latest guideline. Verification of genuineness of transport document. In previous guideline of MTT, it is not mentioned how to verify the genuineness of transport document, but in revised guideline it is being authorized by a Reserve Bank of India to verify the transport document through an online mode. Short-term credit. No such wording has been mentioned. No such wording is there in the previous guideline, but in revised guideline it has been mentioned that it can't be issued in the form of LOC or LOU. Means it can't be issued in the form of letter of undertaking or can't be issued in the form of LOC, right? In case of export leg, in previous guideline, the export leg amount can only be credited in the INR account, means the Indian current account. Whereas in revised guideline, it can be credited in EFC account or it can be credited in INR account. Means here the merchant has option to credit the account in any of the both accounts. Along with that, here hedging is also allowed by the Reserve Bank of India under its revised guideline. Whereas in import leg, there is a limit of USD 2 lakh earlier, but now the limit has been raised up to USD 5 lakh. So now the intermediary can make the advance payment against import leg for up to USD 5 lakh without any bank guarantee or standby LC. Third party payment, in previous guideline there is no wording has been mentioned about the third party payment, but in revised it has been disallowed or not allowed to make any third party payment under merchanting trade charging, neither in import leg nor in export leg. Agency commission, the same, there is nothing mentioned about agency commission in previous guideline, but in revised guideline a specific condition has been mentioned. If that condition has been fulfilled, then the payment can be made against the agency commission on merchanting trade transaction. That's all about my video. I will post the next part of this merchanting trade, means the part 2 of merchanting trade will soon. Thanks for watching.